Let's dive into the world of financial markets. Now, at first glance, it all seems like total chaos, right? Just a bunch of noise. But what if I told you there's a hidden order, a secret rhythm, hiding right there in plain sight? Well, that's exactly what we're going to track down today. So let's start with the big question, the one that's been debated for decades. Are the daily ups and downs of the stock market really just a coin flip? Is it all just unpredictable? It seems like a simple question, but the answer? Well, it's way more interesting than you might think. You know, if you just pull up a chart of daily stock price changes, like these returns for Intel stock, your first reaction is probably, wow, that's a mess. It jumps up, it crashes down, and there's no obvious pattern at all. It honestly looks like the static from an old TV. Now, when the pros analyze these movements, they use a special tool called log returns. Don't worry about the math here. The important thing to know is that it's just a standard way of looking at these changes that makes all the data much, much easier to work with. And here's the fascinating part. When you actually run the numbers, the statistics seem to confirm what our eyes are telling us. There's basically zero correlation between what a stock does one day and what it does the next. Knowing the market went up today tells you, well, pretty much nothing about tomorrow. So that's it then? Case closed, it's all random? Not so fast. This is where it gets really good. What if all that randomness we think we're seeing is just an illusion? An illusion created because we're looking for the wrong kind of pattern. What if the secret isn't in the direction of the change, up or down, but somewhere else entirely? Okay, so let's go back to our chaotic chart. We've pretty much established that the direction, whether it's up or down, feels totally random. But what if you ignore whether the bars are positive or negative and just look at their size, just their height? See it now? Whoa, big changes, whether they're up or down, tend to be followed by more big changes. And these little quiet periods, they're followed by more quiet periods. You see these clusters of wildness and clusters of calm. Now that does not look random at all. And what you're seeing has a name. It's called volatility clustering. And this isn't some minor quirk. It's one of the most fundamental, rock-solid facts about how financial markets behave. It tells us that while we can't predict the market's direction, we might just be able to predict its mood. You know, whether it's going to be a wild, nerve-wracking day or a calm one. So if this market mood isn't random, that leads to a huge question. Can we actually build a model for it? Can we create a tool that can forecast these choppy periods and these calm periods? The answer, it turns out, is a resounding yes. And it completely changed the game for managing financial risk. I want you to meet the GARCH model. And yeah, I know, that name is a mouthful, generalized autoregressive conditional heteroscedasticity. Try saying that 3 times fast. But what it does is just brilliant. It was developed by Robert Engel, who actually won a Nobel Prize for this work, and Tim Ballmer-Sleeve, and it was designed to do one thing perfectly: capture that volatility clustering we just saw. You know, the best way to get your head around GARCH is to think of it as a model with market memory. See, a normal statistical model has amnesia. Every day is a brand new day. But a GARCH model, it remembers what happened recently. It knows if yesterday was crazy or if it was boring, and it uses that memory to figure out how nervous the market is going to be tomorrow. And here's basically how that memory works, in 3 simple steps. First, something big and unexpected happens in the market, a huge price swing. Step 2, the GARCH model sees this and remembers that shock. It updates its internal memory of what's been going on. And then, step 3, because of that memory, its forecast for tomorrow's volatility shoots up. The market is officially on high alert. Okay, that's a pretty cool idea, right? We can actually forecast how nervous the market is going to be. But so what? Why does this really matter in the real world? This isn't just some neat trick for academics. It's actually the bedrock of modern finance. And here's the bottom line. The main reason this is so huge is that it allows giant financial institutions, I'm talking about the biggest banks, hedge funds, you name it, to actually quantify their risk. They can stop just guessing about how bad things could get and start putting a hard number on their potential losses. The tool they use to do this is called value at risk, or VaR for short, and it's powered directly by volatility forecasts from models just like GARCH. VaR is built to answer one very specific, very important question. What is the most I can realistically expect to lose over, say, the next 2 weeks? Okay, let's make this real. Let's say a bank has a $10 million portfolio. They use a GARCH model to forecast the volatility, and then they calculate their 15-day value at risk. And the number that pops out is this, $1,039,191. So what on earth does that number mean? Well, it's not a prediction. Think of it as a guardrail. It tells the bank's leadership that over the next 15 days, there is a 5% chance they could lose more than that $1 million number. And on the flip side, there's a 95% chance their losses will be less than that. That one number is absolutely critical for them to decide how much cash to keep on hand and to prove to regulators that they're not being reckless. So we've gone from what looked like pure random noise to finding a hidden pattern to building a sophisticated model that lets us literally put a price tag on risk. These tools are, without a doubt, an incredible leap forward. They give us a powerful lens to understand and manage uncertainty. But, and this is a really big but, they don't make it go away. And that brings us to our final and maybe most important question. If our models for risk are so good, if we can measure potential losses with this kind of precision, then why do massive catastrophic financial crises still happen? It's really the central paradox of modern finance. And it's a powerful reminder that even with the smartest tools we can invent, the market always has the power to surprise us.